Something strange is happening in San Diego's housing market right now. Prices are flat, sellers are backing off, and inventory growth is losing steam. But when you actually look at the data, it tells a completely different story, one that might surprise a lot of people. I'm Karl, your San Diego realtor, and this is your San Diego Market Matters deep dive into the latest market data to see what's really happening here in San Diego. Now, if you happen to like nerding out on real estate data as much as I do, consider hitting the like button and subscribing to the channel so you can stay caught up on everything that I post about the San Diego real estate market. Now, enough said, let's jump into this. Let's kick things off with new listings data because September's numbers tell us a lot about where supply is heading as we move into the fall. On the detached side, we had 1,700 new listings in September. That's up 3.4% from last year. So while we're not seeing a big surge, it's still growth. On the attached side, condos and townhomes came in at 1,026 new listings, up a stronger 11.9% year over year. Now, when you zoom out, the year-to-date story looks even more hopeful. Detached new listings are up 34% and attached are up 48% compared to last year, both being year-to-date. That sounds like a lot of inventory coming back, and it is, but here's where it gets a little funky. That growth rate has been slowing for months. It was just recently back in spring, we were seeing over 40 and even 50% year over year increases. So while numbers are still higher than last year, the momentum is clearly fading. That means fewer sellers are stepping forward now compared to earlier this year, and it's not hard to see why. With rates still hovering in the mid sixes and headlines shouting about price cuts and buyer power, many potential sellers are pumping the brakes.
Whoa, pump the brakes, Bernard.
Especially those who are already locked in at 3 or 4% mortgages. Because let's face it, trading that for a 6 to 6.5% rate on a bigger loan doesn't exactly sound sexy.
Definitely not.
The result? Supply growth that's losing steam. So even though listings are technically up year over year, the pace is cooling. That's something we'll want to keep an eye on heading into the winter months. If you're a buyer or planning to enter the market in the near future as a buyer, you may want to keep a close eye on this metric. If listings come down, the longer you wait, the more likely it'll be that you're moving into a more competitive market. Now let's move on to pendings, the homes that actually went under contract in the month of September. Detached pendings came in at 1,302, up 7.4% from last year. Attached homes landed at 700, up 3.4% year over year. Not huge jumps, but still wins this late in the year. Here's what stands out. If you compare pendings to new listings, about 77% of all detached homes listed in September went under contract. That means nearly 3 out of every 4 listings that hit the market are already spoken for by volume. The attached side came in around 68%, which is still solid considering condos and townhomes have been a little slower this year. What this tells me is that even though new listings are coming in slower than earlier this spring, the demand out there is still active and engaged. Buyers haven't vanished. They're just being pickier, and when the right home comes up, they are jumping in on it. Now, if you want to see what that actually looks like locally, check out Santa, zip code 92124. Detached homes had 11 new listings in September and 7 of them went pending. That's about a 64% absorption rate, and condos weren't far behind at 62%. On top of that, pendings were up 40% and 60% year over year. So even though supply isn't really growing there, buyers are still clearly active and ready to move when the right home hits the market. It's a great example of how steady demand is still keeping things balanced in a lot of the San Diego submarkets right now. And remember, this is September. Activity normally drops off as we head into the fall. The fact that pendings are holding steady shows the market isn't cooling as fast as you expected. So here's the read.
Straight up, now tell me.
Detached homes are still moving at a healthy clip. Attached inventory is getting absorbed more slowly. The overall demand is staying sticky even as sellers back off, which tells me that buyers might be more motivated to buy than sellers are to sell. Next up, we have closed sales. These are the deals that actually made it across the finish line in September. Detached closings came in at 1,267, up 5% from last year. Attached homes closed at 696, up just over 8% year over year. So even though we're heading into the slower season, transactions are still moving. Now what's interesting here is how closely this tracks with pendings. If you look at the August pendings, about 92% of those detached homes and 94% of the attached homes made it all the way to the closing line in September. That's a really, really strong conversion rate, especially for this time of the year, which tells us buyers aren't backing out once they get into escrow.
Does that sound like news energy?
If we want to look at another way to measure the absorption rate, when you compare closings to new listings, about 75% of detached and 68% of attached homes that hit the market last month have already closed. And of course, that's in volume. That means that the market is still turning over at a healthy pace relative to the number of new listings coming to the market. This tells us that listings are being absorbed rather than just piling up and piling up and piling up. Normally by September, we start seeing a sharper slowdown, but this year that drop from August to September was pretty minimal. That tells me that the market still has energy heading into the fall, and despite the affordability crisis that everyone thinks will crash the market, many buyers aren't buying into it. And you can see that play out perfectly in Point Loma, zip code 92106. In September, 16 detached homes hit the market, 13 went in pending, and 13 closed. That's a 100% close to pending ratio, meaning that once deals are getting into escrow, they're getting done. On top of that, median prices are up more than 13% year over year, and days on market actually dipped a little. So even with higher rates and seasonal slowdowns, the sub market is still moving at full speed, or at good speed to say the least. So here's the takeaway. Demand is not fading, it's finding a steadier rhythm. Buyers are moving with purpose, sellers are being more realistic, and deals are actually sticking. The days of constant fallout and price retrades we saw in past slow seasons, well, we're not seeing them right now. Now, let's look at the median sales price. And this month, we're finally seeing that neutral pattern really set in. For detached homes, the median price came in at $1,020,500. That's down 2.8% from last year. And it's the first negative year over year reading we've seen in a few months. But year to date detached prices are still up 1.4%. So it's not exactly a decline, it's more of a leveling off. Now, attached homes told the opposite story. The median price came up to $671,500, up 3.2% from last year, which is the first positive reading we've seen there in a while. But year to date, the attached side is basically flat, down 0.7%. This back and forth movement, one side up, the other side down, continues to tell the same story we've been talking about for months. San Diego's market is pretty neutral right now. Prices aren't surging, but they're not collapsing either. It's a balancing act between affordability pressure and the limited supply. And if we zoom out, the 12-month average growth rate for detached homes is just 1.6% positive. And for attached, it's already negative 0.3%. So the longer we hang around these numbers, the closer we're drifting to a 0% growth rate. Now, if rates don't come down soon, I wouldn't be surprised to see in 2026 to start off with some slightly negative price growth. Not because demand's falling apart, but because affordability is still stretched thin and price stability is starting to take over. Bottom line, prices are holding the ground, but the growth engine is idling. San Diego isn't appreciating, it's coasting, which is very San Diego, by the way.
Yeah, totally.
Now, let's look at the average sales price, the other big metric we use to track value. Detached homes averaged just over 1.4 million in September, up just over 2% from last year. Attached homes came in at 823,000 some change, up 5.6%. Both positive, but nothing that's pricing buyers out if they wait an extra month or two before they buy. When you look at the year to date, detached homes are up 0.5 point and attached are up 0.9%. That's basically flat. And that's not a bad thing. It means prices are holding steady without the big swings we've seen in the past years. Now, personally, I've always liked the average data a bit more than median because I think it paints a truer picture of what's actually happening out there. The average smooths out some of those random spikes or dips we see when a handful of luxury homes sell in 1 month. And here's what it's showing us. Even though we're seeing mild growth in September, the year-to-date and rolling 12-month averages continue to support the idea that San Diego is sitting right in the neutral zone. Prices aren't running away, not dropping off a cliff. they're just hovering. And this kind of market actually gives people a little bit of breathing room. I've said it before, renting isn't a bad idea right now if you use it strategically. A few years ago, home prices were climbing so fast that if you didn't get an offer accepted, within a couple of months, you could literally be priced out of the market. But today, price growth is steady and slow. That gives renters the chance to save aggressively, invest wisely, and prepare for homeownership without worrying that the market's going to sprint away from them. And I think that's the real opportunity here, stability. Whether you're buying, renting, or planning for the future, this is the first time in years the market's giving people a chance to catch their breath. Now, moving on to days on market, which is how long it's taking homes to actually go under contract. For detached homes, the average was 41 days in September, up 21% from last year. Attached homes sat a little longer at 43 days, which is up 19% year over year. Now that's a slower pace, but let's not overreact. This is totally normal for this time of the year. What's more interesting is that even though homes are sitting longer, they're still selling. The data we looked at earlier showed a really strong conversion rate between pendings and closings, which means that while it's taking longer for offers to come in, once they do, those deals are closing. And I think that this says a lot about buyer psychology right now. Buyers are still there. They're just not rushing into anything. They're being more methodical. They're taking their time. They're comparing homes and waiting for value. Meanwhile, sellers are holding firm longer before considering dropping price. That balance between patient buyers and cautious sellers is exactly what a neutral market looks like. This isn't a freeze, it's a standoff. If you've been to an open house lately, you've probably felt it. Interest is there, but urgency isn't. Homes are still moving, just not at the breakneck speed we saw a couple of years ago, i.e. 2021. In our situation, longer days on market doesn't mean the market is cooling off. It means it's normalizing. Homes are selling at a sustainable pace. Buyers are taking their time, and that's actually healthy for everyone. Now, let's dive into the active inventory, the total number of homes available on the market right now. And this is the one metric that has just really been shocking us like every month this year. In September, detached inventory came in at 3,259 homes, up 19% from last year. Attached homes hit 2,388, which is up 45% year over year. Now, those are big percentage jumps, but let's put some things into perspective. We're still sitting under 6,000 total homes county-wide. That's incredibly low. For context, before the pandemic, San Diego was averaged closer to like 13 to 14,000 active listings at this time of the year. So even though inventory is up from where it was a year or two ago, we're still operating with less than half of what would be considered normal pre-pandemic. And what's even more interesting about inventory is that inventory growth has been losing steam for months now. Earlier this year, we were seeing over 100% year-over-year gains. Now, detached growth is just at 19%. That tells us fewer new listings are coming to the market and sellers are starting to pull back again. So while we might feel like there's more homes to choose from, the truth is that there really isn't. We're basically treading water. And here's where this gets really important. If inventory growth continues to slow or even decline, that can completely offset what we talked about earlier with negative price growth potentially showing up in 2026. Because if supply tightens while buyer demand holds steady, it doesn't take much to shift the balance back in favor of sellers. In that kind of a setup, we're not talking about a 10 offer bidding wars like we saw in 2021, but we could absolutely see multiple offers becoming the norm again. Maybe 2 or 3 strong offers on well-presented listings. So the takeaway here is pretty simple. Inventory is still the heartbeat of the market. As long as it stays low, prices will stay stable. If it drops again though, buyers could be back to competing sooner than they think and probably before they would like. All right, now let's wrap this all together with a total market overview. This is both detached and attached combined together, giving us the big read on San Diego County. In September, new listings came in at 2,726, up about 6% year over year. Pending sales landed right at 2,002, also up 6%. Closed sales came in at 1,963, up just over 6% as well. Those are small but steady gains, and that's exactly what a balanced market should look like. Now, prices continue to hover in the same neutral range. The median for the combined market was 900,000, up just 1.1% from September last year. And the average price is about 1.2 million, up 2.8%. Not a boom, not a bust, just calm growth. Days on market came in at 42, which is up 23% year over year. And sellers received about 97% of their original list price on average. Both of those numbers point to the same thing. Buyers have a little bit more time and leverage than they did this time last year, but they're still showing up. Inventory across the county was 5,647 homes, up 29% from last year, with a month supply practically 3 months worth. That's still incredibly low by historic standards. We need closer to 6 months for a truly balanced market. And this is where we see affordability really having its influence. Now for big picture, new listings are up 40%, but pending and closed sales are slightly down. That means even though more homes are hitting the market, buyers are pacing themselves. They're not rushing, they're not panicking. The market is healthy, it's moving, and most importantly, it's stable. So here's your takeaway. The San Diego housing market isn't tilting one way or the other right now. It's holding steady in the neutral zone we've been talking about, where both buyers and sellers can make smart moves without the chaos. For us in San Diego, this really feels like the twilight zone because we don't get neutral markets very often. And that's a wrap. I hope this data update was valuable and helpful for you to get a better pulse of what the market is doing here in San Diego. Now be sure to like and subscribe if you haven't already. As always, I'm Karl, your San Diego realtor. I'll see you next video.